We are now going to pivot the discussion to talk about SaaS. Our next panel is going to explore the impact of market fluctuations, evolving sales environments, and changing customer expectations. So please give your warm welcome to your moderator, who is at Rotman and at the Globe and Mail. That's Dan Richards, and your panelists. General Partner at Greylock, David Thacker, Partner at NextView Ventures, Stephanie Palmieri, and General Partner at Upfront Ventures, Kobe Fuller. Let's give it up for them.
Well, good afternoon. I'm Dan Richards. Delighted to welcome you all here today. And my main job today is going to be to stay out of the way of three exceptionally knowledgeable panelists on the topic of SaaS. So let's get started, and let's talk a little bit about if we went back 2 years in time, spring of 2021, what would your firm's exposure to SaaS have looked like? And, which particular verticals would you have been concentrated on at that point in time? Why don't we start with Kobe, and then we'll go to Stephanie and David.
Yeah, so first off, it's great to be here in Toronto. So Upfront Ventures, we're Los Angeles-based, and we're pretty agnostic in terms of what we invest in from a technology perspective. But SaaS is an area that I focus almost exclusively on, and I've been doing so for a couple decades now, going back since 2003. And I'd say when I think back to the 2021 time period, and honestly what I consider insanity in terms of the way software companies were valued and the speed at which deals were being done, which was at a pace that was not comfortable for me in terms of deploying capital, it was a period of time where we were pulling back from investing in software companies. So on average, our firm does about 13 deals a year. During the 2021-2020 time period, we were about 9 deals a year, because for us, we're focused on investing in companies and founders where we're able to really create meaningful relationships with. And so when there was a period of time where businesses were coming to us and saying, hey, you have to give us a term sheet in days because we're a hot-flying software company and we're getting all these offers, we were just like, that's not what we do. We want to go on missions with founders for the long term, when we get to know them and we can add value. So during that time period, we were pulling back, and we're being patient and disciplined to be able to just try to find times we can deploy capital at valuations that made more sense to us as founders we actually got to know.
And Kobe, were there any particular common characteristics that would have typified the kinds of companies that you were investing in at the time?
Yeah, so I'd say, honestly, again, I think I didn't do any software deals during that time period. The 2 investments I did, one was an AI-powered wig company, literally using AI to streamline the process for lace-front wigs in African-American women, and the other was a consumer marketplace for shelf-stable food, focusing on a climate angle to it. So I didn't do any SaaS deals during that time period.
Okay. Stephanie, now I'm not sure you were at NextView 2 years ago, but if speaking for NextView, if you can, will you think back 2 years from now, what kind of exposure to SaaS would your firm have had, and were there particular silos or verticals that you liked in particular at that time?
Yeah, certainly. So NextView, we're a early-stage seed and pre-seed focused fund with offices in Boston, New York, and now San Francisco. And we're just very disciplined seed investors. So from a core investment perspective, we're only doing about 2 to 3 deals annually per partner out of our fund as a core investment. And that we've been consistent in that and through our entire 12 or so years of existence as an institutional seed fund. We invest thematically across what we call the everyday economy. So I'm investing in consumer, I'm investing in SaaS, I'm investing in marketplaces across this theme of the everyday economy and how we participate as businesses and as individuals within the economy on a regular basis. And so some of that portfolio is certainly SaaS and more enterprise or SMB SaaS. And then some of that ends up being kind of more transactional commerce. So, from an exposure perspective, I'd say, I don't think we were overly exposed in any one given category. And that's really part of what being a seed-focused fund is to make, at a generalist seed-focused fund, is to make sure we're looking broadly and we're making thoughtful strategic bets regardless of what's going on in the broader market.
Okay. David, back 2 years ago when the world was quite different, for startups generally and SaaS in particular, what would Greylock's stance have looked like in terms of your exposure to SaaS?
Yeah, well, Greylock's a firm in San Francisco. We currently have a $1.7 billion fund, long-time software investors. 2021 was a pretty crazy market. We saw things like valuation multiples went up to 200x ARR. So you had companies doing 1 million of ARR raising at $2 billion valuations, which in hindsight seems totally absurd. But at the time, that's what everybody was doing, and that's what the public markets were, showing. So people got caught up in that. For us, we in 2021 really pivoted to focus more on seed investing. So in early 2021, we announced the $500 million seed fund, just geared towards seed investing. We've got a long track record of incubating at the early stage companies like Workday, Palo Alto Networks, Sumo Logic. So we kind of went back to basics to focus on the earliest of stages. And in terms of categories, I think in 2021, I did 3 enterprise software early stage investments, a company in healthcare called Amplify MD, a general productivity tool called Magical, and then a Series A investment in a company called Progma, which is a gaming enterprise software company. So we did a lot of vertical SaaS at that time, but we really focused more on the early stage.
Right. So, there's been a bit of an evolution in the mindset since, the beginning of the change in landscape. Initially, there was direction for a period of time to the companies at various stages to focus on getting cash flow positive and what Paul Graham calls default to life. More recently, you've seen more focus on, sure, you can get the cash flow positive, that's great, but the bigger focus is on becoming kind of default investable, right? Being able to make the case for kind of having a sustainable picture. And so maybe, Dave, we're going to do it in reverse order. When you're looking at follow-on investments today, what are the things that you're looking at in evaluating companies in terms of judging them that, yeah, this is something that we may not be cash flow positive, but still someone we want to invest with?
Yeah, I mean, I've focused a lot of my time recently on Series A investing, and the bar has definitely gone up to raise a Series A round. I think, as founders, it's really imperative in this market. One of your principal jobs is to not run out of money. And I'm not being facetious. It's that's starting to happen. You're seeing companies shut down every week now because they're not able to raise that next round. So being default investable is really important. At the Series A stage, which I think can be one of the hardest rounds to raise off a seed, because there's a lot more seed capital than Series A capital right now. What I look for is, we have some general rules of thumbs in terms of metrics and things we look for. Principal thing I look for is some semblance of really strong product market fit. So with an early set of customers or users, do they really love your solution? And it's not just, are they using the solution? There's a difference between they using the solution, do they actually really like this? Is it really changing the way they work? Are they planning to invest more in it? Would they be really upset if you took it away from them, right? So these are the key things. And, as Series A investors, we'll call all of the prospective seed investment, we'll call their customers and ask them these questions. And you can tell pretty easily whether someone really likes the solution or whether it's just kind of a nice to have. So if we see that really strong customer pull, that's when we really lean in. And then we'll look for other metrics around that, just in terms of some basic market sizing. What does the competitive landscape look like? What does the customer velocity look like in terms of how efficiently can you acquire customers? Those sorts of things. There's no hard and fast rules around ARR. I think sometimes you'll hear you need 1 million of ARR. That's a nice to have, but really we want to see, for design partners, a lot of times you're not charging them full freight. So we know that ARR can be a harder hurdle, but really seeing that customer adoption is a key thing we zero in on.
Okay. Stephanie, I believe your firm focuses more earlier stage. So what are the things that you're looking at today when you're evaluating companies as potential sites for your investments?
Yeah, we're everything from pre-seed, pre-launch, pre-product, all the way to companies that are in traction. And one thing I'm seeing right now that I think is kind of pertinent to what we're talking about, because obviously I'm working with a lot of companies that are looking to raise that next round of funding, that are looking to raise their Series A's or their Series B's. Something I'm seeing, though, is a lot of these companies that are failing to get to the A coming back and raising the second or the third seed round, right? And if I'm a founder sitting in the driver's seat today, I've got a little bit of whiplash because I was told hit certain momentum metrics and no problem, you'll raise your A. And I think right now the advice I'd be giving to founders that are looking to raise an A is think back to what would have been the bar for an A closer to 2018, 2019. Right? We haven't swung to the point where, A's aren't getting done, but we're going back to much more reasonable, showing a business where you're potentially going to triple your revenue and you can kind of see another triple the next year, where you're getting to that product market fit. And really where I think about you've got a robust pipeline from an expansion standpoint, whether that's product-led growth that's going on within the organizations that you're going at an individual and you're expanding to a team, or if you've got an enterprise kind of go-to-market motion that you're able to show you kind of expand within the enterprise as you move up market. So I think it's really confusing time to be a founder right now because it isn't clear that the metrics we told you needed to hit to get to that next round, well, they're just different today. But they're actually really not that different than they were, 3 or 4 years ago.
Right. So I suspect if you said to founders, this is a confusing time to be founder, you get a lot of heads nodding on that, Stephanie.
I think it is. I think a lot of us are having a little bit of whiplash, right? We were headed in one direction and all of a sudden we're headed in another. And so founders are having this choice between, do I focus on sustainable economics, but I also need to make sure I'm growing? And that's tough to navigate for especially for seed stage companies that don't have large amounts of capital that really can't pull back as they're getting to that early revenue motion.
Kobe, your perspective when you're looking at companies as follow-on investments today, what are the criteria that you're really honing in on? Product market fit is great, but I don't think that's that new. We've been hearing about product market fit for a long time. Are there particular metrics that you're looking at today?
Yeah, I'd say a lot of the same things that was said here already, but I guess I'm going to answer the question a little differently because what I focus probably the most on is just how the founder behaves and can I frankly trust them with money. But I feel like we're living in this world where people just lost the understanding of how much a dollar is worth. And it's I raised all this money and now I can just go hire more people there and just this growth at all costs mentality because I'm just going to raise more capital later and if I get diluted down, I'm going to go and issue myself more options and I'll be fine. It's just understand the value of a dollar, be in control of your own destiny, and try not to build a business that is so much oriented towards what the next investor is going to look for. Think about just building a good quality business, or frankly, you don't need outside capital to run. Look at businesses like MailChimp, Qualtrics, Atlassian. They were able to get to scale without outside capital. It's good not to be able to raise venture capital and then be able to go ring the cash register by late-stage growth equity capital that's lying in your bank account while you go off and build hopefully with a $10 billion exit. Think about, can you build your business for that? Because some businesses you can't execute in that manner, and some you may need to actually take more capital on in early days to actually get to scale. I feel like everyone thinks that we have to take this path towards growth, which is just raise all this money and buy growth, be super capital inefficient, and then suddenly you wake up one day and you realize I'm overvalued, and the public markets are now looking at you actually need to have some sense of profitability. The top, I think, 15 public SaaS companies, average profit margin is positive. It's 23%. Fast forward 2021, it was negative 13% because the public markets were looking for growth. Things have changed. So do you want to constantly be slaves to what the next investor is looking for and the public market is looking for? No, just be in control of your own destiny and run a good business. That's how I think about it. And then if I can be a part of that journey as a VC, I'm so privileged to because I can convince you to take my capital and be on the cap table. That's what I look for.
Mm-hmm. Okay. So I'm not sure that would have been traditional advice from VCs, but you earn points for candor, Kobe, on this in terms of try to avoid going to the market for capital if you can bootstrap. So in the speaker prep area beforehand, we went through the questions, and as usual, we had draft questions that were way too long a list to cover today. But Stephanie and Kobe and David all said, you got to focus on one question. If we don't get to any one, we got to deal with this question. And of course, it's the two-letter word, AI. So what impact do you see generative AI having broadly on the SaaS community? And are there particular verticals that you see either benefiting from or being really threatened or in danger by AI? And I think, Stephanie, you were the most enthusiastic on pounding your fist on the table saying, we got to talk about this question. So we're going to start with you.
My fist must hurt, huh? Yeah, and I think there's a couple parts to that question or answer, which is, there's companies that are, so, I don't invest in the infrastructure of AI per se, but I invest in the application layer, right? And when I think about I think broadly about SaaS, and I think about a lot of opportunities here. I think first off, there's how you're going to apply AI into vertical SaaS offerings, right? And how AI is going to be transformative to both existing vertical SaaS businesses as well as new vertical SaaS businesses that are really bringing a new level of automation and efficiency to, you name the vertical, in the everyday economy. Right, so that's one piece. But the second piece I think about, and again, I think this applies to existing companies that are larger as well as smaller companies, is what I would call like AI native teams. And these are teams that are thinking about bringing AI into their businesses to bring more efficiency to their business processes, right? And so we are now able to do things in a much more efficient way, whether it's enabling sales to get better data out of sales calls, right? To have smarter insights, to get a better read on our pipeline. Whether it means we're actually able to close a deal faster and we can have smaller sales teams or a more efficient go-to-market motion. So I actually think what's really exciting as I look within the Next View portfolio, and I look at a lot of the teams I'm meeting today, not only are they thinking about how AI might be used to create a superior end user experience for the customers of their technology, but they're also thinking about how AI may shape how they form their teams and how they staff their teams in the future in a way that companies may actually be able to be a lot more efficient and focus on bringing core value back to their end users.
That's a great answer. Kobe, David, you want to build on that? Kobe?
Yeah, I mean, it's interesting. I don't know what I think of more, the next AI-powered vertical SaaS solution, or how my current portfolio companies or companies I look at are looking how AI will fundamentally change the way they staff their teams and actually do work, because both of them are fundamentally just like transformative in terms of just where I can deploy capital and then how my business that I invested in or I'm investing in can be run. Like, to think about a world where like SDRs exist, like that role is going to be gone. That's going to be all powered by autonomous agents that are performing the role of a human being that's logging into the existing systems they're using already, whether it's Salesforce or Outreach, whatever. Just extrapolate that across other facets of your organization. From marketing, we're already seeing it in engineering, and to be able to then run a more capital efficient business that doesn't need to hire all these people is going to be increasingly easier to do. So what I say is, as you're thinking about building your teams, building your company, think in a way it's AI first,
right? Because
that's going to allow you to be more capital efficient and be less dependent on venture capital to scale your company in a way I think is fundamentally exciting.
And so, Kobe, it sounds like today, when you're evaluating investments, you're front and center, including the impact of AI in a way that you wouldn't have, say, a year ago even.
1,000%.
Right.
Well, it's crazy. Some of the things we're talking about, I mean, sound like science fiction,
right,
as like recently as like 6 months ago.
Right.
Now it's like, wait, what? That's possible? And then changes the way you think about everything.
Yeah, so the whole competitive landscape has changed in a very, very short space of time, obviously. David, your thoughts on how you look at AI and in terms of
we've been pretty active AI investors, both at the infrastructure layer, companies like Adept and Inflection that are building their own foundational models, but also at the application layer increasingly. And I would echo everything that's been said on the panel to date. I would say the other thing we're thinking about is, it's as a SaaS company, it's very tough to sell into this market. Most customers are cutting back on their spend. They're cutting back on the number of SaaS tools that they use. They bought way too much SaaS in 2020, 2021. And so it's a really tough market to sell into. But one thing that every company in the world is thinking about right now is, what is our AI strategy for our company? How should we be taking advantage of AI? And literally every board of directors is talking about that, not just startups, but bigger corporations. Yeah. And so I think there's a window of opportunity that if you have a very interesting AI value prop, you can get customers to try and adopt you in a market where they're not really willing to try anything else. And so I would really lean into that. I think for most companies, you're either a native AI company, but if you're not a native AI company, if you're doing SaaS, there's probably a way to turbocharge your business with AI. And the great thing about these models and these tools, it's very easy for just a full stack engineer to build something and prototype something pretty rapidly. And so, we're an investor in a company called Tome, which is like a next generation Google Slides or PowerPoint. They were growing pretty nicely last year. They integrated ChatGPT into their product, so you can just type a prompt of the slide deck you want to have created, and it'll just create a first version for you, images and everything, layout. And when they launched that, they're now into millions of users because they've gotten so much great word of mouth. It's just such a cool thing to see. Enterprises want to try these tools and understand for themselves. So I would encourage you all to lean into that.
Okay. I think we have time for one final quick question. So imagine you're talking to a early stage SaaS founder. One piece of advice that you would give, based on the perspective, experience you've gotten, to an early stage SaaS founder. Who wants to go first? David.
I can do it. Related to my last comment, I think because it's a very difficult environment to sell into and to get companies to try something new, I think there's really just a couple value props that really stand out, and your product really needs to address one of these things in a measurable way. The first is if you can help a company grow revenue, that's a huge win for them. Like every company's thinking about how do we grow revenue. The second is how do you help them cut costs, right? Do you have a solution that lets them take costs out of their business, right? Companies are still willing to try those solutions. The third is just around security compliance. If you can make a company more secure, more compliant in an age of like endless number of cybersecurity threats and other things, there's a willingness to try those solutions. And of course, if you have AI, which is kind of the fourth thing tied with one of those things, you can get a really receptive audience. So I would really focus on what you're doing and how does your product help connect to one of those measurable points of ROI. Right.
So really understanding company hot buttons, and are you aligned with a need to do rather than a nice to do?
Yes,
kind
exactly.
of issue. Okay, Stephanie, your advice?
Yeah, and I'm thinking through this with the lens of many of you at the earliest of stages may have very few, if any, customers, and maybe just a handful of users. And so one thing I'm thinking about early is, if for a company to show that the product is a must-have, it has to be part of like my everyday workflow, my everyday experience. And if it's not going to be part of my everyday experience, how is it mission critical to the business? Such in a way that you're taking something that's been broken, where I can't go back once I've started using your software, right? And then I think the big leap of faith sometimes happens between saying, who's the end user of that piece of software, that application, and who's the buyer? Because in SaaS, sometimes it's different. As we look at product-led growth motions, your end user is your buyer until you actually get into, potentially moving upstream to enterprise. But for a lot of folks that are going after more of an enterprise buyer, what's going to make that end user really love and adopt that software? Because at a point in time when all of these budgets are on the chopping block, you've actually got to be the mission critical software that everyday workers don't want to let go of.
Okay, Colby, got 60 seconds.
Yeah, so I actually created a methodology that encapsulates a lot that's been said here already. So in a world where it's so easy to build from a technical perspective, it's all about how do you make the user feel. So its acronym, it's called FABRIC, stands for fast, addictive, bold, rewarding, integrated, and built on community. So if you don't build software that's fundamentally fast, easy to do, easy to actually get to what you need done, addictive, just like ChatGPT, bold in a way that actually just like feels just incredibly badass to use, rewarding, there actually is ROI attached to it. So if you can't find a way in which you're driving value back to the organization, then you're probably going to get ripped out. Integrated, just think like companies like Salesforce. You can't rip that stuff out if you wanted to. It is so entrenched into how your organizations run, partially because they're App Exchange. And then community. Think of Canva, think of Figma. They actually have people that are so fanatical about their business that they come together in venues kind of like this, and they are so drinking the Kool-Aid on that product that if there's a better company to come about, they don't care. That's why Adobe wants to buy it for billions of dollars. Think about the aspects of how you actually prioritize the emotions of your users, and you will find differentiation outside of what AI can do for you.
Okay. Please join me in thanking our panelists. Great session, and enjoy the rest of the conference.